You're watching Mirror 7 News. Stay informed, stay ahead for more news.
So there's been a pretty serious warning issued by the Canada Revenue Agency, and it's something a lot of Canadians may not even realize is happening. The CRA has raised the flag on what it calls aggressive tax schemes that are circulating across the country, particularly schemes involving critical illness insurance products. And while these arrangements may look polished and legitimate on the surface, the agency says many of them are actually designed to help people avoid paying taxes. What's happening is that certain promoters, sometimes a whole group of companies working together, are encouraging people to take part in complicated financial setups. In many of these cases, a person is told to borrow money from a lender who is connected to the promoter. That borrowed money is then transferred to their corporation, and the corporation uses the funds to buy a critical illness insurance policy, often from an offshore provider. On paper, the corporation records the borrowed amount as a liability, and because of that, the shareholder is able to pull money out of the business tax-free. The problem, according to the CRA, is that this whole thing is engineered to look like a legitimate insurance transaction when in reality it's structured to get around tax laws. The insurance policy itself is often not even a real insurance product in the true sense. Some don't meet the standard requirements at all. Instead, the policy is used as the central piece of a circular flow of money where loans, repayments, and withdrawals all appear to cancel each other out. A major piece of this setup is something called a limited recourse loan. In simple terms, it means the lender can only recover their money from one specific asset, usually the insurance policy tied to the scheme. If the borrower doesn't pay the loan back, the lender can't chase after any of their other assets. From the outside, it may look clever or sophisticated, but the CRA makes it clear. These structures are intentionally built to avoid paying taxes, and participating in them can lead to major trouble, and the consequences are no joke. The CRA has the authority to reassess anyone involved and deny all the supposed tax benefits. In more serious situations, promoters and participants can face steep penalties, fines, and even jail time. The agency says it is actively investigating these arrangements and has already taken significant enforcement actions where schemes have been exposed. The takeaway here is pretty straightforward. If anyone is offering you a way to dramatically reduce your taxes through complicated insurance setups, offshore providers, or strange loan structures, that's a major red flag. The CRA is urging Canadians to seek advice from reputable, independent tax professionals before entering into anything that sounds too good to be true. And if someone realizes they've already been pulled into a scheme like this, there is still a path forward. The CRA encourages people to correct their situation through its voluntary disclosures program before things escalate. In short, the message is clear. Be cautious, ask questions, and stay away from schemes that promise big tax savings through complicated insurance arrangements. Stay subscribed for more videos.